So we're going to finish up forecasting tonight so you can get paper 4 done. You got 3 or 4 weeks on that. So on forecasting, we're talking about revenue. I gave you a few choices. The ATO approach, that works really well for consumer retail with stores. That works really well for Costco. So if I were doing Costco, remember I talked about look how many stores are adding and then add on that membership fee on top of that. That would be pretty straightforward. It works really well for consulting. And you use number of employees. There are certain fields where you can just, certain firms where you can just say, hey, their growth revenues, how many stores they build, how many employees they have. In consulting, there are some pretty obvious ones. The next one was segment, which maybe a lot of you is you take the segment, you break up the major segments, you figure out the growth rate of each segment, and you essentially forecast that out. It can be product and or geography. It can't actually be both. Combine them together. And then last one is drivers. So external factors that will drive revenue. A good example might be oil prices or energy companies. So you look at Exxon, and none of you are doing Exxon, but you're doing Exxon, you can certainly take Exxon's historical revenues and correlate it against oil prices and get a sense of what that relationship is. Obviously, they do natural gas. They also do refining. They're pretty complicated because they do so many things. But see what that is, and then go out and look for some forecasts of oil prices, or maybe even do a range, high and low. So that can certainly drive. The other thing you might do is your drivers could be, let's say you're doing EVs. So you do EV sales US, EV sales non-US, or so those give you growth rates, and then you do market share. US market share US. So you have two growths going on. The EV sales are going to be growing fast, but is your market share, if you're Tesla or one of the Chinese companies, if you're Tesla, is that market share going to stay flat, or are you going to actually increase market share? So you got those two things going at once. So what's the overall growth? And obviously here, you got to take total drivers times percent convert to EV. Eventually, that's going to be your last number. You can't have 42 billion EVs sold because there aren't that many people in the world, and not everybody's going to drive, so you can't have 10 billion either. If our world gets to 10 billion and stops, what percentage of people will have a car? So you could probably find something on Statista that shows the number of cars out today, and then get their market share in the US, non-US markets. So you could certainly use that to set something up to get. So those are drivers. If you look at the, find it, the Coca-Cola example, I'm not sure his approach works, but he did a driver approach for his forecast. I'm not sure it's really, the math really works for his way he did it, but it was an interesting approach. So he had growth drivers, and these are the things he put. I probably would have done a combination of drivers plus segments for Coca-Cola: soft drinks versus water versus juices versus energy drinks. I might have broken up US versus non-US, but he did drivers, but it looks more like a segments, but the way he did it is he did percentage of each. So I was just not sure when he did the percentages and they add up, that necessarily makes sense because soft drinks is a much bigger segment than some of the other things. So I'm not real sure it worked, but that's his approach. But sit down and think, what are the drivers that are internal, external to the firm? So external can be your overall market, the demographics, what's that growth rate? So oil prices or EV sales, those kind of things that can give you some sense of what's driving your revenues. If you're doing gasoline, here you got a combination of miles driven. We have that statistic. It's a pretty easy statistic. How many miles are Americans driving? How many miles are people in China driving, in India driving? And then you have to convert that percentage EVs. You know, it's the same kind of thing where you're saying, okay, we make money off of gas cars. We know how many miles are driven. That's going to drive how many gallons we sell. You can also obviously look at miles per gallon efficiency. That's going to hurt. So if you're trying to figure out a Valero, so Valero sells refined gasoline and diesel, you might break it up to different segments. But how many miles are Americans driving? So in 2020, what happened to miles driven? Dropped dramatically, all in that 1 year. I think recently China might have crossed the United States in number of miles driven. I'm not sure about that. There's something in the back of my mind on that. So Valero needs people driving, but they don't make money off of EVs. And then as cars become more efficient or even less efficient, because Americans are buying the big SUVs now again, how do you bring all that together to get a forecast for this company? But you also have gasoline prices. So, you know, you look at each one of those and what you're saying is, what's my opinion on miles driving? What's my opinion on EVs? What's my opinion on each one of these? You're working together to help give you a forecast from revenue, and you weave that into your discussion. I'm not expecting great forecasts from you because it's really hard for the people who know what they're doing that are in these industries that do good forecasts. You're just tangentially hitting this, so it's be tough. You know, Sebastian, how would you handle with Sebastian? I might be looking for, you know, eating out versus home trends. I might start with that. Are people starting to eat more at home? There's more home deliveries. I might look at market share on that, something along those lines. You know, you try to find something you can get your hands around, that there's some statistics. If there's no statistics on this, how often do Americans eat at home versus eating out? If you don't have statistics, then you've got an issue there. And it's more than eating at home, but because now you have HelloFresh, which is actually delivering meals to home, versus DoorDash that's delivering other people's meals. But you sit down and just think about it. How do I get my hands around the growth on this? Now, Sebastian has a huge advantage that he's got a business breakdown. How many of y'all have a business breakdown for your company? So a few of y'all do. That helps a lot, doesn't it? Yeah. Gives you insight, because that's what they're asking about. What's the growth rate on this? What is going to happen? So that gives you huge. You might look at business breakdown for a company that's similar to your company to see how they're talking about how to project this firm going forward. So those kind of things that you're looking for. All right. Then once you get that, you have the forecast model that we know has a few problems in it. I fixed this one where I fixed 2024, but we know on the graphs had some serious problems there. So if you have any issues there, you'll just have to maybe get with me. But it's essentially, as I added more years, I forgot that to go across. So you just want to make sure the columns P, Q, R, S, T, U. And how do I get the two lines? The way I do the two lines is I just do the data twice. So I get this line, and this whole line is blue, but this line is red, and so the red just lays over the blue, so you see the blue on the red. There's probably a different way to do it besides that, but that's just the way I've got it to work. But you can manage this somewhat. If you want to use these graphs, most students actually use the graphs I prepared. You just got to fix them and clean them up. You probably want to delete for firms that don't have that much history, you're going to delete the columns you don't have, but just be careful when you delete the columns. you don't want to delete the graphs as well. So the graphs are down below. So if you're going to delete columns, I would move the graphs over so that you don't get rid of them. All right. So I'm not looking for great forecasts. I'm looking for some decent discussion. Most of it is going to be on revenue. So 50% of this is on revenue. The rest of it is exactly what I did for Walmart. You can definitely use Walmart. Once you get your revenue up there, the rest of it is just going down and looking at history and forecasting your firm going forward. This firm, DoorDash, doesn't have a cost of goods sold. Or wait, I guess they do. They have a, okay. So you just look at the history. For a firm like DoorDash, you probably want to look at the longer term history and get a sense what the trend is. It looks like it's coming down. So you might trend that down some, but essentially you're going to extrapolate from history into the future and then discuss why you came up with those assumptions. So after you get revenue done, the rest of it is just kind of explaining how you decided to pull the history forward. All right. If you need help on the forecast, come talk to me. I might be able to give you some pointers. I've done a lot of forecasts in my career. None of them are good. We're terrible forecasters. USA had forecasts. I don't know why they do forecasts because they're always horrible. You can know a horrible forecast when they show you a 10-year forecast and you ask them, do you expect a recession in the next 10 years? Oh, yeah. Well, how many recessions are in your forecast? None. Like, okay, well, then you already disagree with your forecast. So why are you doing a forecast? And why does USA do a forecast? They do a forecast because they want a forecast. They say they do it for decision-making purposes, but they don't because they don't make any decisions off of it. To me, it's an incredibly waste of time. I don't know why they bother doing it, but they do forecasts. But here you do a forecast because you've got to get the future value, future cash flow of the firm so you can discount them to come up with a valuation. You probably want to think in terms of best case, base case, and worst case, and maybe do some scenarios. I would do those mainly on your revenues, but you may want to think about what's the range on this company, what could really, really work. That's what the mortar end talks about. We talked about that. Possible, plausible, probable, and worst case. One thing I like about business breakdown is at the very end, it says, what could go wrong? What would be the scenario where 5 years from now, it doesn't work out? They're doing horribly. What would be that scenario? Is it a new competitor? Is it a new whole disruptive industry that comes in, a whole new technology? What would that be? Obviously, the worst case is you go out of business. Now, is DoorDash still losing money, Sebastian?
DoorDash?
Have they made a profit yet? But most firms like DoorDash are still losing money. It makes it hard. Sebastian's gonna have a tough time with paper 4. So definitely. We may not be able to look at it, but I don't know how to DoorDash. It's just called Dash. Should we remember that one? Let's see if it'll let us look at financials. Yeah, they're still losing. Yeah, they're not only losing money, but the losses increased the last 12 months. So it's gonna be a very tough page. Sebastian, a couple of y'all are probably gonna have to sit down with me at paper 4. We're gonna have to figure it out. I know, like with Beverly, you got a problem with negative net worth. That's not a horrible problem to deal with, but no earnings is definitely a challenge. Some of the charts may just not work, and you'll just have to bear with it. Right. So I'm going to set you off on forecasting. Do your best. Use your logic. Use what you know about finance in all your classes. You'll be doing many, 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 many forecasts in your life. In fact, there was a firm. I had a consulting firm. I had got one gig, but a firm asked me to build a forecast for property and casualty insurance. It took me 1 week. They paid me $10,000 many years ago, probably $20,000 now. So, and USA let me do it. So I took vacation, got paid $10,000, and USA also paid me. So it was kind of fun. But they didn't understand the property casualty insurance industry, and I just built them a forecast and showed them how to do it. So, forecasting is pretty important. It's a way you understand your business, way you take the history and try to project it into the future. So it's an important part of understanding finance, understanding financial ratios. If you look at the components of paper 5 or paper 4 for the forecast, you got revenue, you've got the rest of the income statement items, you got the balance sheet, and you have your ratios. So it's, once you get revenue, the rest of it falls into place pretty easily. All right, so now we're going to switch. We're like 2 classes behind. I'm setting you off on paper 4. You can start working on paper 4 right now and get it done. You know, it's very straightforward. The first part, you're just going to follow the liquidity, solvency, turnover margin section and just follow that just like we did in class. So that should be straightforward. And then the forecasting, just do your best. I'm pretty lenient on grading on forecasting, but I can tell you made a valiant attempt. You didn't just throw, you didn't. I've had some students, their forecast was exactly what was in their file, which means it was their company with all Walmart assumptions. And I'm looking at it going, yeah, that's, you know, Walmart's growing 1% a year. Your firm's been growing 60% a year. Yeah, that's not going to be a good forecast. Their firm's gross margin was 80%. Walmart's is 20%. So suddenly that drops down. And they actually wrote the paper like that. It's like, yeah, I expect their margins to drop from 80 to 24 because of competition. I mean, they just made stuff up. And it's obvious they did nothing but just take what was already built in there for Walmart and they just applied it to the company. And that will not give you points. In fact, on that one, I'll probably just email you and say, try again. You can resubmit the entire thing. So, all right. Now I'm going to go to the class notes and we're going to talk about discount rates. I'm not going to do the introductory slide. All right. So for the next part of the paper, it's valuation, which is actually in the title of this course. Those that took my investment class, you did this for paper 3 and 4 in there. Very, very similar. Some students that took my investment class actually used paper 3 for an investment class and just edited it. Because you can use the risk-free rate market risk from that paper. So if you want to do that, that'd be perfectly fine. So you need 3 numbers, really 5, because you're going to run some scenarios on beta. So you should know this backwards and forwards. Everybody should know the capital asset pricing model. It's still a big part of CFA exam 1. It was the easiest part of exam 1. They just kept asking CAPM questions. They would give you risk-free rate and market risk premium. You got to figure out what beta was. I mean, it's just really simple. It's on the fact exam, obviously, over and over again. So what we're looking for with your discount rate is CAPM, risk-free rate, plus beta times a market risk premium. You're going to start off your paper justifying these numbers. The fortunate thing on the risk-free rate is the 10-year treasury is back to normal. And so this part of the notes don't actually even make sense anymore. But you do need to think about if the 10-year treasury drops back below 3 or 2%, you got to start thinking about, can you use the 10-year treasury? But the 10-year treasury, so something you might want to do that's pretty simple to do is do a historical chart. So you can just do 10-year treasury yield. And then Fred, y'all know who Fred is? Who's Fred? St. Louis Federal Reserve. So you go down, here it is. And there you got a graph. You can do the max if you want to, or you could do 10 years. So if you want to say, and so most of you, I recommend just use the 10-year treasury yield, whatever the current one is. So back in 2020, it got so low. You had to make some adjustments, I think. When the 10-year treasury is 0.5%, I think it's really difficult to say that's the risk-free rate. The Motorin said you use the 10-year. Back here, what I did is I used the forward rate. And even then, you got a really ridiculous. I was shorting treasuries back here. When the 10-year hit 0.5%, I was shorting treasuries. I just said, how much lower can they go? And someone said, may go down to 0.25. I said, yeah, I can handle that. I won't lose much if it goes from 0.5 to 0.25. And then I sold to the wrong place. I probably sold somewhere around in here. I could have waited all the way up to here. I mean, I bought back. I shorted and then I bought back. Actually, I bought an ETF that was short 20-year treasuries. So if interest rates rose, it went up in price. Because that's just so ridiculous. Y'all don't have that problem. 10-year treasury is actually pretty close back to its normal level. You look at 4%, that's pretty normal, especially for the last 20 years. You kick out the 80s, 70s, and 80s, that was just ridiculous. If you look at the long term, it's been about 50% of the time above 4.5%, about half of the time below 4.5%. So 4.5 is pretty normal. Where are we today? Oh, and this is the old version. Maybe Chrome will give me the right Yahoo Finance. We'll see. Where is it? Where is Chrome? I hate Yahoo Finance. I'm so mad at Yahoo Finance. It's going to mess up your beta, and I'll show you why, but I did fix that for you. Nope, still out there. 10-year treasury. Okay. Let's go to the source.
How do you say US, right?
Yeah. So the 10-year today is 4.2%. That's a pretty decent number to use as a risk-free rate. So there makes it really easy. So this part of it is you just got to say, I'm going to use the 10-year treasury for the risk-free rate. It's currently at 4.2%. As you can see from the graph, it's back to more normal levels. There's no reason to make any adjustments. Very easy part of the paper. Why the 10-year? Why not the 3-month? The 1-year, the 5-year? So there are people who use the 30-year. The problem with the 30-year is that it is a specific market, that there's just a certain number of buyers and some supply and demand there that doesn't really reflect reality. It's just there's very few people who buy 30 years. Really the same thing with the 20-year. Shorter term, you get such a volatile rate that it really messes up your valuation. So for the longest time period, a 10-year has just been what we've used, and you're safe using a 10-year. That's probably what 95% of people out there use. The guru on this is Ibbotson, Dr. Ibbotson, and he actually publishes several risk-free rates, but most people use the 10 years. So you don't, in your paper, have to explain why you're using the 10-year and not the 5-year. At UTSA, we use the 5-year because that's what the CEO said to use. I was so looking forward to a big debate with him because I had a lot of really good debates with him over the time. He always won, of course, but he went with the 5-year. My argument on 5-year is it's too volatile. It changes too much. And so he was trying to set it up as a target for UTSA for our bonuses. And he was going to give a number that's going to move around a lot. So the 10-year is a little more stable. It's not quite so volatile. So that answers the risk-free rate. So just use the current, but give context. So it's probably gonna be a really short part of your paper. I'm not looking for much there. Market risk premium. How can you do that? There's several approaches here. We're going to use the implied approach, but throughout almost my entire career, probably 80% of my career, it was the historical approach. I don't recommend you use the historical approach. The Motorin uses the implied approach, but the historical approach was the approach. It was this guy Ibbotson. He produced history back to 1922. Anytime you see 1922, you're probably using Roger Ibbotson's data because that's how far back he went. And essentially what he did was he looked at the total return stocks minus bond yield. Treasury bond yield. He actually used something slightly different than the bond yield, but we'll just go with that. And so that is essentially what he's saying, what stockholders actually got were treasuries. And his argument is if they got 5% historically, then they should be happy with 5% going forward, and that's the number we're going to use. The problem with this approach is the United States has been an amazingly wonderful place to be a stock investor since 1922. And you could certainly make the argument that what investors got the last 100 years wasn't what they were needing to cover for risk, that they actually were very pleasantly surprised. And so the actual return they got was much greater than the actual return they needed to cover their risk. And in that case, the chance that you're going to find all stocks are way too expensive because you're going to say, yeah, we need 7%. excess return. That's what we got historically. There's no way we're going to get that going forward. So you'll never buy stocks because you're going to use too high of a discount rate. So that's the problem with that approach. I'm not criticizing Ibbotson because if he was here, he could certainly argue all over the place on these numbers. He also uses the implied approach. He's an impressive guy. In the 70s when he started his career, he was one of the early people to do something y'all all know how to do. Remember duration from my investment class? He was the early adopter of duration. He said buying bonds was like shooting fish in a barrel. It was so easy for him. So he knew something you now know, but people back then didn't know. So he's an impressive guy, impressive. He's on some podcasts you should listen to. Really, really deep thinker, very highly respected in the industry, but he lost out on the historical approach. He had something called the Ibbotson equity risk premium book. I forget what it's called. It's maroon. You'll see it. I don't see it in here. There it is. The yearbook, SBBI yearbook. So he was really famous for this. It's only 20 bucks. We use this at USAA. He had monthly returns for large cap stocks, small cap stocks, and treasuries. And we had no data. So I was actually manually keying all that number into Excel spreadsheets and then updating it. So that was our main source. Then we got Bloomberg and had access to it. But it was a really, really good use. I don't know who buys this now because you can get all this pretty easily off of Bloomberg. I mean, you might use him to get back to 1922, but once you get him 1922, you can pull your data going forward. But there probably are some people using this right in the middle of this book. We bought this book at USA. I flipped through until I found the big X, and that was the page he gave his market risk premiums. And I just pulled that number off. I sent it around USA everywhere. But the SBBI is stock, bond. Oh, you also have T-bills and inflation. So he had that data monthly back to 1922. Very, very good source. Why he hasn't updated this for international stocks and emerging market stocks and growth and value, I don't know. But those are the ones that he's provided. So that's the historical approach. There's the VIX approach that argues the market risk premiums should be a function of the VIX. Y'all know what the VIX is? Anybody? Volatility index. What is it really? How do you give the detail on the VIX? It's a very specific number. It's 18.2. 18.2 what? 18.2 times 18.2%. What is that? So this one's actually percent. So what is, anybody know? What is this priced off of? It says CBOE, so that should tell you something. It's options. It's the implied volatility in 3-month S&P 500 options. Is what the S&P 500 options, what volatility pricing in for the next 3 months, but it's annualized. All right, so 18% annualized. It follows very closely to the 90-day vol. So if you were to graph the CBOE VIX against the last 90 days volatility of the S&P 500, you almost can't tell the difference except for in certain points. Certain points of VIX will shoot up, like around COVID, suddenly shoot up. It won't reflect on the last 90 days. But if you look over time, it very closely follows the 90-day volatility, which means options are very sensitive to recent volatility. They price in the last 90 days. But they will jump around with news. So when we saw the Japanese market, when Japan raised interest rates, you can see how the VIX reacted to that. Remember that weekend we got really bad jobs report and the Bank of Japan raised rates. You can see the VIX reacted to that. So if you model that against the last 90 days, it would have shot well above it. So you'll see those kind of shooters. If you do the entire period, there's the 2008 crisis. There's the Tokyo earthquake. There's COVID. You can see COVID got really up there. COVID got close to the 2008 crisis. There's the dot-com crash. So you really are, that's the 98 long-term capital management. There's the dot-com crash. But you notice 87 is not in here, but if you had 87, supposedly the VIX got above 100%. So I think I've told some of the other story, but there's a woman on our board at UTSA who developed the VIX. She's a professor from Rice University. And as soon as I heard that, I had the longest conversation with her. And she was so nice. I mean, it was great. I was a professor, she's a professor. And she sent me her entire database that they did to build this. Unfortunately, it was sitting on the computer at UTSA, so I should have, if I'd been smart, I would have printed the whole thing out and taken it home with me because it was really fascinating. So she actually had the VIX for October 87, and she said it actually went above 100%, which really doesn't make sense because you can't lose more than 100% of your money on stocks, but the VIX actually jumped up. So the theory is your market risk premium should move with the VIX. And what I've heard people say is your market risk premium should be 30% of the VIX. So if the VIX is 0.182 times 30%, that gives you a market risk premium of 5.46%. I got that from JP Morgan. So that's one approach. That's a pretty simple approach. If you use that approach, you'd have to write more about it.
So what do you do again?
It's just take the VIX, 18.2%, and multiply by 30%. That 30% is not my number. I stole that from JP Morgan, but that's what they use. Now that's going to be pretty volatile too, but it makes a lot of sense. And the VIX obviously shot up in 2008. Obviously, you would be using a higher market risk premium in 2008. It makes a lot of sense. But at the same time, it's probably going to get you to sell stocks at the wrong time and buy stocks at the right time at the wrong time, because when the VIX shoots up, stocks get really cheap. And a high VIX is going to say you should have cheap stocks. Probably at the time you should be buying stocks. But it is correct theoretically, but probably bad as an investment strategy. So that's the VIX approach. The corporate spread approach says that the VIX and the MRP should be a function of corporate spreads. So when spreads are wide, the market risk premium should be wide. There, I can show you this. It's the latest I have. I thought I updated this, but I guess I didn't. I might have updated this. Yeah, I did update this. I just didn't change the file name. So here's corporate bond OASs. So when that shoots up an OAS, I mean, remember OAS? Take my investment class. What's the S stand for?
It's an option adjusted spread.
Option adjusted spread. Why option adjusted? Because there is some spread for optionality. You don't want that in the option adjusted spread. So this is pure credit. So the theory is when this thing shoots up, your market risk premium should be higher, and it should just be a function of that. Right now, we're at a pretty low level for spreads. So is that good? We were at a pretty low level of spreads right before the 2008 crisis, so that may not be a good sign. We're at a pretty low spread going into the 2000 crisis. So who knows? We did see a pretty good jump with inflation, got a big jump, with the earthquake and other things. These are high yield. You can see even AAA spreads really gapped out dramatically. So I don't remember the formula I used on this, but corporate spreads, I'm not saying your company spread. I mean corporate spreads overall. So none of market risk premium has nothing to do with your company. If you say anything about your company on the market risk premium, you're going to lose. You can lose points. Market risk premium is for all stocks, right? Especially all large company stocks, right? So the implied approach is the approach I want you to use. I did not put the article out there. I have to give y'all the article. Let me find it from Refuse class. I'll put it out there for y'all. Here's the JP Morgan. Let me just show you their presentation. I can put that out there for you as well. I had a canvas blow up when I was bringing stuff over. So this is very old. And I almost got their updated one because we had someone working for JP Morgan. He said, I found the guy who did this. He said he's going to send it to me. And then that student quit and got a new job and right in the middle of that. So it's old, but the nice thing about it is it shows you their approach. It's the most important number in finance, the market risk premium. Now, I know it says do not copy, restricted, but I emailed all 4 of these people, and one of them got back to me and said it was fine with me sharing it with my students, so don't try to get me fired. They say it's perfectly fine. Plus, it's 14 years old, so we don't have the most updated one. But they go through it. It's really, really good discussion. They show you the range that it can be. So here's their different methods. Historical. The dividend discount model is essentially the implied approach. They have a constant Sharpe rate ratio method. My boss did that. I didn't like this approach, but that was his approach. Bond market implied. There's where you have the spreads. Dividend yield method, which is another one that's very similar to the implied. Surveys don't work because surveys is people doing all these other approaches, so you're just backing into it. But they show you that they make it interesting. It's again, I wish I could get the updated version on this. But the one I want to show you is probably the best one, which is Barclays. So I sent a member of my department to you won't believe this, but there was a market risk premium conference where they presented like 2,000 papers. He brought them all back on a disc, and it just almost killed our. I don't know how he got it all back. He had a massive disc of these things, but we did not read the articles because most of them were unreadable, far too difficult to read. But this is the one that we got into. Barclays really introduced the historical approach. And this is the one you want to know going into your career because it's probably what you're going to see out there. You want to understand it. And so these 2 guys, I don't know if they're still living or not, because this is an old paper, but it's really, really good paper. They call it the most important number in finance as well, or maybe one of the most important numbers in finance. I can't remember which. But essentially what they say is this right here. Here's the formula. So where do you get a return on stocks? You get a yield. That's called income. You get earnings growth. That's inflation plus real earnings growth. And you get repricing. This income here is your dividends yield minus the change in shares outstanding. So if you're buying shares back, that's a negative, so that increases it. If you're issuing shares, that's dilutive, so that reduces it. So that's what they say is what a stock return is. And they're going to make an important comment here. So let me make sure I have it in here, but I'm just going to give it to you again so that you just see how this works. It works better for my mind if I just give you the summary. So you really want to understand this. You're going to definitely see this in your career. So there is a required return on stocks, and there is an expected return on stocks. Required return reflects risk, and extra return cover risk, and it is entirely theoretical. There's no place to go get that number. It doesn't exist out there. Entirely theoretical. Expected return is what stocks can be expected to earn, and it's going to equal a dividend yield plus growth plus repricing. I can type. That's expected return on stocks. Boy, I can't. Miss Quinny is my typing teacher from high school, would not be happy. So what this argues is this number doesn't exist anywhere. This number we can figure out. And then they make the big leap that said required return should equal what? The expected return. And why is that? Because nothing else makes sense. If markets are expected to make 8%, but your required return is 10%, you won't buy stocks. Stock prices will fall until when the expected return hits the required return. If the expected return is 10% and your required return is 8%, what's going to happen? Everybody's going to be buying stock, prices can go up, the expected return is going to fall to 8. So because markets are efficient. That's the theory. There's one massive problem with this theory, all right? For those of you not on your phones, there's one massive problem with this theory. Can y'all think of what this is? First of all, who is this person? But which investor? Is this you? Yeah, this is all investors. Are the average investor. Do you care? What are we really looking for? Aren't we looking for your required return? Isn't that what you care about? Where would you go get your required return? That's theoretical, that's subjective as well. So what do? I don't know what I require, so I'm just going to use the average investor. Does that make any theoretical sense whatsoever? But that's what we do. If you're a very conservative investor, your required return is probably going to be much higher than the average investors. If you're a very aggressive investor, your required return will be much lower. Maybe you should start and ask if you're an aggressive or a conservative investor. That may be where you start, and maybe you're going to add a premium or subtract a premium from the average investor. So remember, when you're doing this approach, if you want to really blow them away in an interview, I always ask CAPM questions in my interviews. Explain beta for me, and very few people. I had a graduate student from Yale, MBA, had no clue what I was talking about. It's kind of embarrassing, but yeah. I've had students in my classes have no clue. I'm like kicking them under the table in the interviews, like, this. But that's the theory, is what you're going to use in your pricing model isn't what you believe. You're out there aggressively seeking the average investor's opinion. So the other problem with this is it possible markets are mispriced? And that's a serious problem with Barclays. I'm going to show you why I have a definite problem with Barclays. So I'll get into that. All right. So I have some problems with this. I wish I could have been at the presentation rather than this, because I would have asked a lot of questions. I'll show you my biggest question I had for them. But essentially they said, to get the expected return on stocks, all you got to do is forecast these items. This one you don't have to forecast because you just go look it up. Right? So what are you going to do with your papers? So the expected return has these components. Dividend yield. You just look that up. Let's see if I can get it. Well, I don't know. So anybody remember where you get this from, Yahoo Finance? SPY. You just get its current yield. What is it? 122. So there it is. That's the current yield on stocks. I'm actually going to do this as an entire YouTube video as well. And go through this again so you can watch it. But I'm more concerned about your interviewing and knowing this stuff. This is really, really critical stuff. So does that sound like a high number or a low number? That's pretty low, isn't it? The historical average has been more like 4%, so that's pretty, very low. What might we adjust this for? What are we doing today that we haven't done historically? Yeah, stock buybacks. I will give you that article from Ibbotson on stock buybacks. It's an old article, but I've tested it and it's still true, hasn't really changed. So stock buybacks equal dividend yield or a little more. So if dividend yield is 122, you might add 1.5% for stock buybacks. But I'll show you that article. We'll get into that. All right, but it hasn't changed much. Companies are still buying back more stocks than they're paying in dividend yield. Again, it has nothing to do with your company. Don't talk about the dividend yield of your company. Don't talk about if your firm. I've seen students talk about, well, my company is not doing stock buybacks. It has nothing to do with this. We're talking about the entire market. All right, so don't bring up your company at all. All right, so I'll give you a number here. Maybe it's 1.5%. Wouldn't be a bad number to do. It gets a little tricky because firms issue stock options to employees and management, and that can distort this somewhat. But one way you can tell stock buybacks is that earnings per share growth is greater than earnings growth. Because the way stock buybacks get into your calculations is it reduces the denominator on earnings per share. So your earnings per share grows faster, and that's really the extra growth we're looking for. The earnings itself doesn't grow faster, but you as a stockholder, your earnings per share grows faster because people are coming out and you're a bigger owner. You have a higher stake in the company.
Wait, so, but how did you come up with that number?
The 1.5. I'll show you his article. I mean, essentially he's going back and taking stock buybacks as a percentage of the stock market, but then he's adjusting it for options and stock issuance. Historically, issuance was greater than buybacks. But then a few years ago, they completely switched and buybacks are greater than issuance. So historically, this is actually, you could have argued this is a negative number that you subtract it out because firms were issuing more stock than they were buying back. People didn't make that adjustment, but now people are buying more stock. So you can't just look at the stock buybacks. You have to look, you have to do the net issuance. So that's the real key. Y'all see that? The real key is how is the share changing? Because as shares come down with stock buybacks, earnings per share is going to be higher and you get more growth out of earnings per share. So you as a stockholder are benefiting because you went from being a 1% owner in the firm to 1.3% owner of the firm. Okay, so you'll definitely want to make this adjustment. You have to make this adjustment or you can get really bad valuations. I'm just warning you now. Make sure you put the stock buybacks into your paper. Make it a paragraph or two. Maybe I'll show some of your papers from last semester. Some of y'all put that in your paper last semester, didn't you? You all remember doing that? Well, I'll see and show you how you handle that. So that's the dividend yield. Earnings growth is going to be a big part of your paper. Anybody remember what this is? Now, this paper breaks between inflation and real growth. I don't need you to do that because you're going to indirectly do it. So anybody remember how we did this in my class last semester? Earnings growth is a function of what? Economic growth. So nominal GDP growth. I'll get you these graphs. So let me show you from my investment class because it's in a PowerPoint. It makes it a little easier to show you. And I did update them. Some of y'all recognize all this. Some probably gonna have a nightmare tonight because I showed you this. All right, let me first start with this one. This one wouldn't go into your paper, but this is just showing that the return of the stock market is dividend yield plus earnings growth, because that's what this graphs. All right. The blue line is the actual return on the S&P 500. The red line is each decade's dividend yield plus earnings growth. So I love this chart. You should take this chart with you. I'll put it out there on our campus. So it just shows you that's what stocks give you, except for the .com. 2008. 2008 was the last time we went back to the line. We've gone above it. So what does that mean? That either means stocks are materially overpriced or something has changed. So there's two things that could have changed. One is the stock buybacks, but I did add that in there, so you can't argue that. But I really think what's happened is two other things. And if you have my investment class, we talked about it. I think this is really critical to understand, because if someone give you the bait that stocks are really expensive, they do look expensive on this line. They do look expensive when we look at what Shiller does. But the two major things that have happened in the last 20, 30 years is, first of all, expensive for buying stocks have come way down. And so I think we got a one-time adjustment on that. Commissions are zero now. Just buying stocks is so much cheaper now than it used to be. I bought a treasury today from Schwab. I bought the treasury. I immediately clicked trade status, and it already traded. I mean, that's a treasury. When we talk, stocks are more liquid than that. I mean, it's just amazing. We don't need people trading anymore. I don't even know what they do. Y'all want to tour the New York Stock Exchange? I don't know what people are doing. They probably have actors in there pretending to do stuff, because it's all computers now. So that's part of it. And the second thing is risk is actually lower now because we have so much more information. And I think we had a one-time adjustment. We kind of got ahead of it here. A one-time adjustment, 2008 brought us back down, but I really think we had a one-time adjustment for risk and expenses to investing. And I think going forward, you're probably going to see the blue and red lines moving in parallel, because you had that one-time adjustment. I do think stocks could be overpriced, especially in the United States. So you may see a 30% adjustment, which would still keep you above the red line. But I do think the blue line should be above the red because of those two things. And then the second thing to ask is on earnings growth. So this chart you do want to put into your paper. So you're going to argue, why are you using the U.S. economy to come up with what you think earnings growth in the U.S. is going to be? Not for your company. Again, ignore your company. But what will earnings growth be? And so I love this chart as well. The green line is the growth in our economy. The red line is earnings growth. And you can see the economy has grown 6.4% and corporate earnings growth is 6.1%. Now, how can corporate earnings grow more slowly than the economy? Well, that's because this is the S&P 500. It's those smaller companies, private companies that are the faster growth that are making up the difference. So the large cap S&P 500 is actually growing more slowly in our economy because we have a bunch of smaller companies that are growing faster. What happened in 2008? Who did that to us? Which industry did that to us? Financials, and what discipline did this to us? Accounting. What accounting do? Fair value accounting. That's all fair value accounting. We probably would have had the same problem in previous years, but we weren't doing fair value accounting. Bonds were not marked to market. Suddenly we marked bonds to market, and bonds were getting written down 15, 20, 30%, just wiping out earnings all over the place. So whatever you think the economy is going to grow, that's going to be pretty close to what you think corporate earnings are going to be. The Motorin says you should use a 10-year treasury yield as your long-term growth for stocks. That's a much lower number, 4.2%. And then I threw 5% in there. I mean, historically it's been 5.6%, but the current yield is 4.2. He says use the current yield for your long-term growth. That's what he does in his market risk premium. That's his long-term growth. And then the 5%, I just put that in there as kind of a floor because it does tend to kind of bounce off of that. So we had some really good bouncing back off of COVID here in earnings. but we've actually had a decline. That's all the inflationary pressure. And then we're starting to recover now. So this is your chart to justify that you're going to come up with your long-term growth in stocks earnings by using your long-term growth for the US economy. Let's see how many of y'all are listening to my class last semester. Where does GDP growth come from? Productivity growth. Labor growth. Plus inflation. So there's how the economy grows. Which of those is the most important one? Productivity by far. If you want to be wealthy 20 years from now, you better hope the US is very productive. We haven't been last few years, but productivity growth. What is productivity growth? Definitely want to know this. So productivity equals real GDP growth minus labor hours growth. So essentially, we're asking, did we produce more? Now, if our economy grows, we're taking inflation out, grows 2%, but we had 2% more people working, there's no productivity. If our economy grows 4%, but only 1% more workers, that's a lot of productivity. And that is the wealth of nations. You want to know which countries are rich or which companies are poor. It's all about productivity. Which countries are really struggling with productivity? You know, UK, Germany right now, just a disaster. And it's really interesting. Germany is really struggling right now. Why? Because it's an export country and we have these big trade wars going on all over the place. So Germany was like the winner, so much productivity, but with them being so dependent on exports, that's really destroyed them. So that's what we're after, productivity. So I have a chart for that you also want to put into your paper 5. So I've updated this through 2024 first quarter. I haven't updated for the second quarter. I love this chart as well. But inflation's on top. You know, inflation does give us higher economic growth, but then we're destroyed because we have to pay more for stuff. So that's not what you want. And then labor growth and productivity growth, and you can see how weak productivity has been. I combined, I don't know when I'll break out the 20s as its own decade, but I combined the 10s and the 20s. But productivity, I think that's the weakest we've ever had. 2010 through 2024 is the weakest productivity we've ever had in our country's history. In the 2000s, the first time in our history, we actually had fewer people working at the end of the decade than at the beginning. So essentially what you're going to do is you need to forecast those three things. I give you the medians here, that gives you 6%. I don't know anyone who thinks our economy is going to grow 6%. But I'll tell you, if you want to be reasonable, you're going to be between 4 and 6%. That's on nominal GDP. You know, what's reported in the news is real GDP. So real GDP is more in the 2 to 4% range. But 4 to 6%, if you get outside of that range, you're getting out into weird land. The only way you can get a 6-7% GDP growth if you think inflation is going to be 3-4% or something along those lines, which you can make a strong argument for that. We got a massive government debt. How do you solve massive government debts? You monetize it. You just let inflation take care of it. So you could certainly, there are people out there arguing for 5% inflation so we can get rid of our deficit. You know, could the American public live with that? That'd be really interesting to see. We really freaked out with the 6% inflation we had in 2022 to have a constant 5%. It is interesting when I started my career, I had to forecast inflation. And I remember telling them, I think we should start using 5% because inflation's really come down. So I was arguing 5% as a low number. People were saying that's too low, 5%. So you see where we're going now. We think 5% would just seem insane today. What would you use for labor growth? What's going to crush labor growth? Baby boomers and AI. So you have to think about that. Are we going to need workers? Or all of y'all going to have jobs? You better be learning AI. If you're not using ChatGPT and Copilot to write Python and macros, start learning it. Start letting it do that for you because that's really, really critical. It's probably not going to replace you as a worker, but workers that know AI will replacing workers that don't know AI, so you better learn it. So who knows what impact that's going to have. My guess is AI is going to start creating whole new industries and whole new jobs. So we'll probably be creating jobs we can't even think of today. But we do have the baby boomers retiring, and that's a big segment of our population. We have to have immigrants coming in to take the place of those workers, and hopefully we have a good immigration policy. So you got to talk about that somewhat. And in productivity, why is it so weak? No one really has gotten a good explanation. How can you have productivity so weak? We have the internet, we have AI coming in, we have robotics, we have all this stuff coming in that should be making us more productive. What's probably killing this? Probably social media. We're definitely much less productive. So that's why I highly recommend you read Kyle Newport. If you're an iPhone zombie, it's going to destroy your career and you will be replaced by AI and people who aren't zombies. So do you know how much time you spend on social media daily? Do you get the report? You got to find a way to kill that. It's just going to destroy your life. You will not be successful in finance if you're an iPhone zombie. So who knows what that's going to do to productivity? That probably is a part of what's killing it. It's definitely killing teenagers. I rode my bike by a bus stop. There's probably 20 teenagers. And guess what? 100% of them are doing. They're probably texting people standing 3 down from them. It's ridiculous. It's really sad. It's going to destroy us. If you can destroy social media, you will have a huge advantage over your peers. That's what watch Cal Newport's TED Talk. His people he's working with are like, how are you publishing so many articles? It's like, I'm not on Facebook. I'm not on Twitter. Now I'm on Facebook, but I'm retired, so I can get away with it. If I weren't retired, I would be destroying all of that and not doing it at all. Or I'll be doing 1 hour of Facebook a week just so I can brag about my latest bicycle accomplishment. And then the next week, see, I got, 16 likes because I know 1/10 of people y'all know. But yeah, that's what destroying. So that could be part of it. I think the other part of this is definitely we're becoming more service oriented than manufacturing. And it's hard. It's hard to get service industries productive because it's so people, but that's changing too. I went into McDonald's where no one would talk to me. I had to use the kiosk. That's going to be, have y'all seen that yet? That's happening more often. How many of y'all order kiosks for the food court over here? Y'all doing that? Any of y'all? Mm-hmm. Are y'all doing it on your app?
Yeah.
Does that work pretty well?
Yeah.
And is it saving them workers? That's kind of the question. Do they have fewer workers because of that?
Productivity move.
Made me more productive. Who knows? I watched United Airlines go to the kiosk, and I promise you they had more workers instead of fewer workers. They had people sitting there helping people on the kiosk, so I'm not so sure. But you got to ask about the future. What is it going to be going forward? So you could certainly make an AI argument that we can get much more productive. Kiosks, drones, autonomous vehicles, moving to more alternative energy, those kind of things that are going to make us more productive. You can certainly make those arguments. But historically, 2% has been it. I don't think you can make a strong argument for 3% productivity. I don't think you make a strong argument for 2% labor growth. So I think you're talking 2% productivity, 1% labor growth, and 2% inflation. You're talking about a 5%. That's why I say it's between 4 and 6%. I mean, our country would love to have higher GDP growth. So something else you could add to this paper is nominal GDP. What word am I about to type? Fred. There it is. You can edit the graph and do percentage change a year ago. And you notice two things you notice. First of all, much less volatile. What's the second thing you notice? Lower levels. You see that just coming down. See that 5%? 5%? You can see why I say 4 to 6. Look at that 5%. It used to be 6%. You see it's 5 now. Now that could be higher inflation back then, definitely. But so you're not going to argue a 7% economic growth. Now, I know President Trump said that. I think he said 6, and I think he was talking. No one was sure if he meant real or nominal. Hopefully he meant nominal. 6 would be a real stretch, I think, for our economy. I mean, how do you get it? You got 2% productivity, 1% labor, you're gonna put 3% inflation, that's not gonna help you much. How do you get that extra 1% if your 2% is inflation? Are you gonna add it to productivity or labor growth? I think you have a tough argument. Maybe it's productivity. Some people might argue if AI gets us to 3% productivity, then probably labor growth is going to be 0 because we're not going to need workers. We'll just let the baby boomers retire and we just want to replace them. We'll just replace them with AI. But that's the discussion you're going to have in that part of the paper. Go back and look what you did if you have my investment class and see. If you haven't, then maybe ask some of those people to see that paper. But that's what you're looking for here. You can certainly put a productivity graph in there. I don't think I've ever in my last typed productivity right the first time. Here, you probably can get a bunch of them, but just take the first one. This is the percentage change annual. And again, you notice less volatile, but lower and lower levels. It's coming down. You can kind of ignore COVID. That's just ridiculous. So it's just coming down, less and less productivity. This longer term chart really is the movement going from manufacturing to service, because our productivity in manufacturing was amazing. I had some statistics on the steel industry. I can't find them, but how many people it took to do a ton of steel? I mean, it's gone down dramatically, like 80, 90%. It's just amazing. I mean, just think about farm labor. We used to be 96% farmers. Now we're 2% farmers. Where did all those farmer workers go? So we've gone from 96 to 2%, and we're not just producing food with that 2%, we're feeding the entire world with 2% worker. Now, I know we're killing everybody with really bad food, so maybe that's a problem, is we've gotten too efficient with it. We have all these hyper processed foods, but the manufacturing side, the farming sector is getting really productive. What are the 2 least productive sectors? Y'all remember? Education and healthcare. Y'all remember that? Yeah, and that's a big part of our economy. And those are not getting more productive. Healthcare, my previous class, we talked a lot about that. There are certainly inroads of AI into healthcare that could certainly make us more productive. That's the discussion you're going to have. It's probably going to take you to a couple pages to get through that. You'll show these 2 charts, this one and this one, in your paper, and then you'll come up with your assumption. And when you do that, you will have the first 2 parts of CAPM. You'll have the risk-free rate, and you have the market risk premium. One thing you might want to do for the market risk premium is do the Motorin. I think he calls it equity risk premium. No, he calls it market risk premium. Well, I don't know. He calls it one of the 2. Probably calls them both. He has a country default. You don't need that because you're using a US. He does have spreadsheets he provides for free that are kind of amazing. So you might look at some of the stuff he's doing. His numbers look real similar to mine because he is also using the implied approach, so it's going to look real similar. So, right, where I want to go next class, I want to start, if I remember, to talk about the major flaw in this paper. Just because you got to understand this is an extremely important part of finance. This is the most important number in finance, extremely important that you understand it. And in all the interviewing I'm doing, very few finance majors understand this. So I want you to be out there in the 1% that understands this versus the 99% that took a multiple choice question and knew how to match words, but had no clue what they're talking about. You've got to understand this. And part of the way I want you to understand this is a major flaw they make in their final answer, which is that -75. So hopefully I'll remember to do this at the beginning of class. I want you to understand why I think that's a huge mistake. I might have talked about it in investment class, so you might remember it from there, but we'll start there. And then we'll get into a long discussion on beta. On beta, in the past, we used Yahoo Finance. We can't use Yahoo Finance anymore, but I created a spreadsheet in Bloomberg you can use. You'll have to go to the Bloomberg lab to use it. But I created a video to show you how to do it, so you can follow the video and just bring in the data. So you have to use Bloomberg instead of Yahoo Finance. All right, we'll stop it there. So you got to get paper 5, the first part. You've got 3 numbers you got to do. Risk-free rate, which is very straightforward now. Interest rates are somewhat back to normal. Market risk premium, we're talking about now, and then we'll spend some time on beta and what I want you to do in this class with beta. So this is the implied approach. You figure out how much is the stock market going to make. You assume that that's the required return. It's your expected return, but you assume the required and expected are the same. And they're using something very similar to us. You got the income return, which for them includes 2 things: the dividend yield plus stock buybacks. I'll give you some information on the stock buybacks here. Next couple of classes, we'll talk about that. But the income return is your dividend yield. That was about 1.5%, and then they added 0.75% for stock buybacks. This article is pretty old, so the stock buybacks have essentially doubled, and dividends have fallen. So it's more like 1.2% plus 1.5, but I'll give you some numbers that you can use. You've got real earnings growth plus an expected inflation. We're going to combine those 2 together. The way they did it is they tied real earnings growth to economic growth in the United States. That's what you're going to do. And then they added inflation. So you're essentially, this is going to be productivity plus labor growth and then plus inflation. So you can combine these 2 together. And that's the only pieces you're going to have: income return, expected growth. But here I want to talk about the mistake I think they make. So essentially what they say is the stock market's overvalued. So we think over the next 10 years, you're going to get a lower return of 0.75% until the market gets back to the appropriate pricing. So if you think about that, they think the expected return stocks equals 8.25% minus 0.75% for overpricing. So they think the market's overpriced. So you're going to use a discount rate of 7.5%. All right. Let me give you 2 discount rates: 7.5% and 8.25%. Which of those 2 discount rates is going to give you the higher valuation? 7.5. They're saying the market's overpriced, and they're recommending you use a discount rate that does what to your valuations? Increasing them. What discount rate should you use? You should use 8.25. If you use 8.25, what you discover? You discover the stock market is overpriced. What are they telling you? The stock market is overpriced. Do you want to use a discount rate that doesn't tell you the market's overpriced, just kind of makes you buy expensive stocks? Or do you want a discount rate that's going to show the market's overpriced? So this is going to overstate the value stocks. So more stocks look cheap when you're rich. This one is going to correctly value stocks, so fewer cheap stocks. Which would you rather do, managing someone else's money? I think I'd rather do the latter. I think they made a big mistake in subtracting to say market's overpriced, so we're going to reduce your discount rate because we recognize. So what did they mess up on? They forgot the one thing. We said expected return equals required unless what? Markets are mispriced. They left that little part out. So if the markets are overpriced, expected return doesn't equal required return. In fact, expected return is lower than required return. In that case, you want to use a discount rate that's higher than the expected return. You want one that's higher, and then you're going to see the stocks are overpriced. All right, huh?
So they just took out 0.75 because they thought it was overpriced?
Right. The way they did it is actually pretty simple. Is they decided what the PE ratio should be, and they compared it to the current PE ratio, and you just took that difference and spread it out over 10 years.
But how did they come up with that?
They talk about it, what the appropriate PE ratio is. A lot of it's tied back to where PE ratios should be, given where interest rates are. I mean, there's a lot of things you can do. PE ratios are highly correlated to inflation. There's a chart I like to use. You can see there's a high correlation. So like a couple years back in 2022, when inflation got so high, stocks are ridiculously expensive. So either stocks are ridiculously expensive or inflation is going to come down fast. So when inflation's high, PE ratios should be low. When inflation is low, PE ratios should be high. And that's the adjustment they made. So they say a 10% repricing can take different paths. So they spread it out over certain number of years.
I see.
But they're still saying that they think the stock market's overpriced. If the stock market's overpriced, give me a discount rate that shows stocks are overpriced. That's what I want. So instead of having 200 stocks I can buy, I may only have 50 I can buy because so many are overpriced. But that's exactly what I want. I want to buy stocks that are not going to fall 0.75% a year because they're overpriced. So I like their approach. Other than that, one adjustment doesn't make sense to me. And in fact, it actually gets ridiculous because here's the risk premium is dead. People think stocks are going to make 3.9%. Well, if you do that and use that as your discount rate, you're going to buy a lot of stocks. It makes no sense. So their theory somewhat breaks down here at the end. But I do like the paper. It is a good paper. I will put it out there if I can remember to put it out there on Canvas. I have it already out there, but it's just a matter of bringing it back over. All right. So for this part of the paper, you get the risk-free rate, just pull the 10-year treasury. And then you have to somewhere in your paper just say, you're going to, here's the points you're going to make. Expected return on stocks equals the required return on stocks. Expected return on stocks equals dividend yield plus buyback yield plus expected earnings growth. And this is nominal, not real. So you should just write that in the intro paragraph, and then expected earnings growth should equal about expected nominal GDP growth. That's where you're going, all right? And then expected nominal GDP growth equals expected productivity plus expected labor growth plus expected inflation. So that's essentially that second part of the paper. So your first part's really easy, just a risk-free rate. So expected productivity, if you want to bring in a productivity historical chart, that would certainly add power to your paper. You could look at more recent decades. I'm essentially doing that for you here, so you can definitely use this chart in your paper. So you come up with these numbers. My argument is, I think reasonable is 4 to 6%. I'm not saying you have to be in the 4 to 6% range. I actually think it's probably closer to 4 than 6, but you'd be pretty wild if you're getting 7, 8%. 3%, we're in a bunch of trouble. Medicare and Social Security is just going to absolutely crash. So you need to get something that 4. The other reason you be in the 4 to 6% range, I can just let you know, when you do your valuations in the next part of the paper, I know what discount rates work. And that's one of the reasons you need to add in a buyback yield, which I'm just going to tell you, you're going to add 1.5%. That's a good number to use. I've tested it a few times. Dividend yield, we got that from the SPY yield. And then expected earnings growth, you're going to get from here. Expected productivity is probably going to be in the 2% range. Expected labor growth in 0 to 1% range. Inflation probably in the 2 2 to 3% range. So you're going to be somewhere in that 4 to 6% range. It's not a difficult paper to write. Some of you have already written it from my investment class, but you can use a lot of that again, although I did update the charts and you have a little bit better charts. Now, what do you do with this then? So you got your expected return equals, let's say you get 1.2% dividend yield plus 1.5% buyback yield plus 5% growth. That gives you 7.7%. So what is your market risk premium? Don't forget to do this part. Market risk premium is what? Required return. Y'all remember this? What do you do next? Minus the risk-free rate. That gives you your market risk premium. I'd like to show you the Motoran. I should have loaded the Motoran before we did this, see where he is. He's generally, you know, if the current risk-free rate is about 4%, that's going to give you a market risk premium of 3.7. That seems low to me, but it's low to me because the expected return is just low right now. I know Dave Ramsey says stocks can make you 13%. Yeah, I don't know what drugs he's on, but that is an expected return. Just because it's done it here recently is just not. What is Goldman Sachs saying? Next 10 years, stocks are going to make you 3%. You can't use that either. Neither one of those is going to give you 13%. All your stocks will look way too cheap. 3%, you have a problem with your valuation. Remember, I'm going to yell at you like my mom's emails. Your KE must be greater than your growth. Your KE has to be higher than the growth rate for your stock. So if your KE gets too low, you're gonna have a trouble. You know, if you have a KE that's 6% and your growth rate's 7%, you're gonna have a lot of trouble. Y'all see why the buyback yield is so critical here. You're just not going to get a decent discount rate for your valuations. Some of you are going to get some valuations of like $87,000 for a stock that's trading for $100. It's just what did I do wrong? Well, there's probably something wrong with your expected return on stocks. I mean, it's possible the stock market is just you know, if you're getting a 6% expected return on stocks, then you probably are saying the stock market is overpriced. So it gets back to the problem with the Barclays article. All right. So you can definitely get expected productivity. I showed you how to do that. You just do productivity and Fred. Fred is just such a good help. You can bring those in. And this one's already doing year over year. So you can certainly do that. Look at history if you want to bring a little extra analysis into your paper. I don't even mind you taking a picture of that, although it's pretty easy to download it into Excel and you can create your own chart if you want to. The nice thing about the Fred chart is that it highlights recessions, which I think adds somewhat to the picture. But you can definitely see, I mean, you have to take COVID out, but you can definitely see an average up here, or maybe here, 3%, and then an average of 1 to 2%. You can definitely see a big drop the last 20 years, last 15 years in productivity, especially if you take COVID out. That's a completely artificial number. What if you have a small company? So if any of y'all have a company under, say, $10 billion, you can add a small company premium, say of 1%. So if you're under 10 billion, I don't know if any of y'all are, most of y'all are doing pretty large, few of y'all. DoorDash might be that small, I don't know. Or Diego, your stock might be that small. Oh, I forgot to look at I'll have to look at it tomorrow. But some of y'all may have smaller firms. I don't know about IMAX and some of them. If you have a smaller firm under 10 billion, you might add another 1%. And that might help you because you might have a higher growth rate for a smaller company, and it does help you have a higher discount rate. Now, what's probably going to happen is you're going to come up with a discount rate that's too low. And then you're going to go into the valuation. You get valuations too high, and you say, wait, I meant to use 8.2%. Are you going to go back and fudge your numbers? And that's just the nature of what college students do. That's actually what professionals do as well. So I would write on this part, when you get to this part, if you get a number below 7%, you're not going to like it. Just to warn you, all right? So I'll try to show you the modern, if I can remember before next class, to show you his numbers so you can see what you're in the ballpark. He's using the same process, so you can see what his numbers, how he's getting his numbers, and certainly do an assessment of if you're assuming something too crazy low or too crazy high. You're probably going to be too low. That's probably going to be your biggest problem. Now, make sure you do this. Some of y'all may have seen this. I do CAPM as risk-free rate plus beta times the market risk premium, but you may have also seen it as risk-free rate plus beta times required return minus risk-free rate. I think most college classes it teaches like that. Have y'all seen that like this in your classes? I think most classes. I don't know anyone in practice that does it like that. We all just talk to market risk premium. So if you get out and practice, do it like this. They'll look at you funny if you do it like this. They'll know what you're doing, but this is what normal people do outside of academia. It's the more common approach. So come up with your market risk premium, you're just going to use that. The market risk premium doesn't matter much if your beta is 1, because then your stock's return is 7.7%. If your beta is 1, you're not adjusting it, you're just going to come back to the 7.7. Where the market risk premium becomes important is when your beta is well below 1 or well above 1. That's when it's kind of a huge impact. That's the other thing, be really careful. If you're doing Costco or Target or some low beta firm and you have a low market risk premium, you're going to get a really low discount rate, and it's going to cause you all kinds of problems when it comes to valuation. All right, I'm not saying cheat and exaggerate things so you get a better valuation, but it's definitely going to be an issue for you. All right, so that gets you 2/3 of the paper. So let's talk about beta. Now, I just talked about beta in my other class, so it's going to be one of these things where it's like, what did I tell one class versus what did I tell the other one? So in beta, you're going to have 3 scenarios at least. You can do more than that. I encourage you to do a data table so you can do a lot more betas than just the 3 scenarios. Another thing I got to bring to you is the CFA example I had in my exam. They had 138 different scenarios. It was just pretty wild, but a bunch of them were on beta. They did test different beta levels. So let's talk about beta. You have some more notes. All right, so beta. So let me show you what I showed my other class, because it's kind of nice that the two are linked up here. So we've got NVIDIA and the S&P 500. All right. NVIDIA's risk is massive. If I annualize this, their annualized risk is 45.87%. The stock market is only 15%. So NVIDIA looks 3 times more volatile than the stock market. So what does beta say? Beta says that's the wrong measure of risk for a stock. It's the right measure of risk if you're looking at your total portfolio. Standard deviation measures total risk. But if you're just looking at NVIDIA, it's not the right measure of risk. So what does CAPM say? Why is that the wrong measure of risk? Y'all remember? Why aren't you going to use this for your discount rate and use a discount rate like 27% or something? What happens to NVIDIA when you put it in your portfolio?
Diversified.
It's diversified. How much of NVIDIA's risk goes away? Do y'all know how to calculate that? What percentage of NVIDIA's risk is systematic, tied to the market, and how much of it is unsystematic that diversifies away. Y'all know how to calculate that? It's a function in Excel. Any guesses?
Correlation,
Close.
regression,
Exactly, correlation, but what do you want to it? I'm asking what percentage. So, you know, correlation can be -3. You can't have -30%, -0.3. You can't have negative. So how do you get it not to be a negative number? You know, part of R squared, which is correlation squared. So you're exactly right, Omar, if you'd squared it. So if I do the R squared of NVIDIA versus the S&P, I get 31%. That means the unsystematic is 68%. What they're saying of this total risk, 45% standard deviations, 69% of it completely disappears when you put it in diversified portfolio. So we're going to ignore standard deviation for our risk. And what we're going to do is focus on systematic risk. All right.
can you break down that calculation for the annualized risk?
Well, it's monthly data.
Right.
And so the annualized standard deviation multiplied by the square root of time. There's 12 months in a year. So like returns, you can annualize returns by multiplying by 12. But risk, you can't annualize. You can annualize volatility. Remember, standard deviation is the square root of volatility.
Right.
You can annualize volatility, but you can't annualize risk. But if you, so I could take volatility and multiply it by 12 and then take the square root of that, or you just take standard deviation and multiply by the square root of standard deviation. Right? So we're ignoring an enormous amount of risk for NVIDIA. NVIDIA is a very risky stock. You know, most stocks, well, Apple is like 40%. A lot of stocks are in the 20s. So this is a very, very risky stock, but we're going to ignore 69% of that risk because we assume that risk is going to disappear once they jump into a portfolio that's diversified. All right. So that's the theory. And remember this, that it's so easy to, you can even put this, I've never seen a student do that, but you could actually put this in your paper on beta, how much systematic risk your stock has, because you're going to have all the data there when you do the analysis. It's sitting there. It'd be an interesting approach. What I've done with systematic risk is I've actually measured it over time. And guess what this percentage does for most stocks in a year like 2008? Jumps up dramatically, like to 60%. What does that mean? Like so much of finance, you have a tool in finance that works really, really well unless you need it, and then it falls apart. So in 2008, when you really needed diversification disappeared because everything was crashing. So that's kind of the downside of finance. We're like fire extinguishers that work unless it's the heat is there's a lot of heat, or an airbag that works unless you're in an automobile accident. So diversification works really, really well unless you're in a crisis, and then it doesn't work. Systematic risk jumps dramatically, not the 40%, 50%, jumps just 60, 70%, because all stocks are just nosedive. But over the entire period, 69% of risk would disappear in diversification.
What was the 14.6?
That's the standard, that's the S&P 500. So this is the stock market. So they're 3 times more volatile than the stock market. Apple's like 40%. A firm like Walmart might be 24%. All stocks are more risky than the market, right? Because when you combine them together, diversification brings everything down. Right. So this, I would remember this is such a powerful tool, and it's so easy. It's just that R squared, which is correlation squared of those two functions. So what Beta is talking about in a well-diversified portfolio, that's real important. You're valuing HEB and you're one of the HEB family members, you're not going to use capital pricing model to value HEB because you don't have it diversified. It's your entire portfolio. So you have to find some other way. In fact, if HEB went public, the value of HEB would go up tenfold because their discount rate would fall from like 20% down to 6%. The value of the firm would be enormous. I don't know why they haven't go public yet. They will soon, sometime next 10 years, because as each generation is splitting up $1 billion to 40 people, 80 people, 1,000 people, they much rather that be 10 billion than 1 billion. And so eventually they're going to have to go public just to raise. But that's the problem with an HEB is now it's possible. I know HEB has a profit sharing kind of thing that they do. It's possible those valued HEB for the profit sharing are actually using CAPM, but that would be entirely wrong to do that. They'd be really ripping off the HEB family. So, so I don't know, any of y'all work for HEB? Are you part of the profit sharing? No, no. Well, if you get part of it, come tell me how they do it. I'd be curious. I'd love to see the inside scoop. I'd be curious how much they'd be worth as a public company. They have a lot of really valuable real estate. So if you're well diversified, what Wim Sharp is saying is only look at the systematic risk. So stocks have two risks: systematic risk, unsystematic risk. Systematic risk is non-diversified. They're undiversifiable risk. What that means is you cannot reduce systematic risk by just throwing more stocks into your portfolio. So if you have 100 stocks, you say, hey, put another 50 in there. If you do that, you're not going to reduce your systematic risk. The only way to reduce systematic risk is to sell high beta stocks and buy low beta stocks. That's the only way to do it. Just throwing more stocks in your portfolio will not do that at all. Beta as a measure of systematic risk, or really beta as a measure of relative systematic risk. So NVIDIA's, y'all know how to calculate beta in Excel? Anybody? What did y'all do in your other classes? What function do you use?
Correlation.
Not correlation.
Slope.
Slope. Yeah, slope. And which one do you have to put first, the company or the market? Got to do company first. Then you got to do the market. So 1.76, I don't show betas as percents, 1.76. You cannot say NVIDIA's systematic risk is 1.76. What you have to say is NVIDIA's systematic risk is 76% higher than typical stock. It's a relative measure. Okay. So they're 76% more exposed to the economy, interest rates, inflation, geopolitical events. They're 76% more exposed. Now, maybe it's even more than that. So we know during the dot-com crisis, tech stocks betas shot up pretty dramatically. We know in the 2008 financial crisis, financial stock betas shot up. What would NVIDIA's beta do if China attacks Taiwan? Would that impact them, given that TSM is their major producer of chips? You might see them, the market falls 40%, you might see them fall 80, 90%, who knows? It'd be pretty insane. They can't sell anything. I don't know who's going to make their chips in that case. So these numbers move. That's what we're going to talk about that. These numbers move over time. However, for your paper, you're not going to use 176. 1.76 is the regression beta. It's historical. What beta do you need?
5.
You need the future beta. Where do you get the future beta? Wherever you go look up the future beta of NVIDIA. Doesn't exist. All right, so I'm pretty radical, but I'm going to show you, and this is something UTSA students don't do, I'm pretty sure. So I'm showing you something that's going to separate you from them. So I'm going to say beta is a forecast number, just like growth. So where do you get the growth rate for your firm's earnings? You make it up. You come up with it. I'll give you some tricks that can help give you a ballpark, but it's a forecast. Can you get historical growth? Absolutely. Very easy to do. But are you going to use historical growth to forecast NVIDIA? Like, wow, they've grown 200% in the last couple of years. You're going to use that going forward. You get a really, really big firm. You do that. So just like we don't use historical growth to do future growth, we don't use historical beta to give us future beta. So beta is something that is forecast. I say it so often, I now have a t-shirt that says that. One student bought me 3 t-shirts that says beta is not a number you look up in Yahoo Finance. I wore it to Columbia University and walked around. No, I didn't, but I joked that I went up and found finance majors and said, hey, you know where to get beta? You go find it in Yahoo Finance. But a lot of them do. Most colleges, that's what they do. They do regression betas. You probably did this in one of your classes. I bet this looks familiar. Y'all remember doing this? That look familiar? Y'all doing that in a couple classes maybe? I hate this chart. It doesn't tell me anything. Beta is the slope of that line. That's fine, but that's the entire period. If you do this with Walmart, what you discover is Walmart is 30 years ago, their beta was like 1.5 because they're a small firm in small cities. It was a small cap stock, high beta. Today, their beta is like 0.3, 0.4. Use the entire period of time, you don't capture those two Walmarts. So I do betas, you'll see, some of y'all have done this before, betas over time, rolling betas, and that's what's going to be required for your paper because firms' betas are not very stable. So I would never use this chart. I've had some professors complain that I do the rolling beta. They're like, why do you do that? Because this is the standard way. This chart just doesn't tell me anything. I don't know where the time is here. Maybe all of these were the .com, although I don't think they existed in there. But this could be all the .com period. This could be during COVID when they were going up and everybody else is going down. Who knows? It's so time dependent. So the reason I changed my opinion on this to this approach, beta as a forecast, is several years ago in this class, I had invited a portfolio manager. He was in town, really smart guy. I wonder if he's still alive because he's pretty up there in age. And he said, I can talk anything I want to talk. I said, yeah. I said, what if I contradict what you say in class? I say, that's even better. So he came in and said, they don't use beta at all. He doesn't like it. And he did a rolling beta. This is the first time I've seen a rolling beta. And he showed, I think he showed Merck, and Merck's beta went all over the place. Said Merck has been doing the exact same thing for 30 years and said sometimes their beta is 1.4, sometimes it's 0.6. It's been very unstable. And there's a reason for that. Beta is climate dependent and can be fooled by noise. So you just got to be careful of that. So betas for .coms, as I said, shot up in 2000. You're going to use that going forward? Probably not. Are you going to use the bank betas from 2008, the value Bank of America going forward? Probably not. They shot up too high. And they also going to be fooled. If you have a firm that had a huge down week, when the market was down, maybe they announced a new CEO or CEO leaving, so their stock fell a bunch, but it just happened to fall a bunch the same time the S&P fell a bunch. Beta doesn't know that. Beta is going to interpret that as systematic risk because it's just pure coincidence. The day when the market's down a bunch, they were down a bunch. It could have been the same thing here. They announced something unusual here. It looks like it's not beta. It looks like it's non-systematic. These two could be the same thing. They could have lost 10% here. Got some announcement. They lost another 10%. But beta sees that. And the other thing with beta, the reason noise is so important is beta is extremely influenced by outliers. And that looks like an outlier. You lose 18% in 1 month. It looks like, something crazy, really crazy happened. So you got to be careful of that. Some betas are just artificial. And so that's why I do the rolling betas. And when you see something really unusual, you can ignore that period of time. You can look at the median over time. I forget the company I did in my other class. I'll have to show you that one. But it was a firm whose beta was really low. If you look at the rolling beta, that was right now is the lowest it's ever been. So if you do, this is what UT Austin does. I admit it's much easier. You go into Yahoo Finance, you click on the firm, and you're done. There's their beta, 167. How did they get it? 5 years monthly. We can test and see if they actually did it correctly. 5 years would be 60 months. So equals slope NVIDIA versus the market. 1.67, does that look close? What do y'all find it show? 1.67. That's all they're doing. Are the last 5 years indicative of NVIDIA going forward? Has anything unusual happened with NVIDIA in the last 5 years? COVID, AI, all these kind of things. Who knows? That's a high discount. That's a high beta to be using for a firm. So that's all y'all can find, but that's what most students do. I may have told somebody else story before, but I remember years ago, a team was doing a team project. They were doing a retailer, I think a clothes retailer. And they wanted me to look over the numbers before they presented to Dr. Misra. So they showed it to me, and they're talking, like, and our beta is negative 0.6 and blah, blah, blah. And I go, wait, how's your beta is negative 0.6? Yeah, that's what Yahoo Finance showed. That what retailer that sells clothes has a negative? What clothes do you run out and buy in a crisis? Are they selling like, protection jackets or something? I don't know. Are there retail clothers that love recessions and people buy twice as much of their clothes? It didn't make sense. So I said, if I were you, I would ignore the beta in Yahoo Finance, and I would use a more reasonable beta for a firm that makes sense. And they did that, and they ended up getting a really high grade for doing that one thing. So it's like, you owe me now. But Misra was really impressed that they did that, but that's what most students do. And I've seen students do that when they get a beta that makes no sense whatsoever. And they just plug it in and get a number. It's like, yeah, my stock's worth $85,000. Current price is $20. I'm recommending a buy on this stock. And they'll say that with a straight face. I was like, does something seem a little off to you that you're getting such a high valuation? So that's why I don't like just use these regression betas. It doesn't always happen. This 167 is probably reasonable for a firm like this. But you still want to look at the history and see if you're at an unusual period in time. So unsystematic risk, these are things you can diversify by simply throwing more stocks into a portfolio. It's easily diversified. All you got to do is pick up the phone or go on the internet and buy a Vanguard index fund. You've completely eliminated all your undiversifiable risk. I have Toys R Us in here from my old notes. You can't even talk about that one anymore. So ignore that. So total risk is standard deviation. I'm not throwing out standard deviation. It makes sense if you're looking at your total portfolio. That is the best measure to use. But for an individual stock that's going to go into another portfolio, you want to use beta, right? Now, why am I bringing all this up? Because I ask the question I like to ask on an interview. This is my question. That's my one question I like to ask, because every finance student has seen CAPM in 4 or 5 classes. How many students interviewees have given good answers? I can remember 2 out of the hundreds of people I've interviewed. It's really pathetic. I don't know what the problem is. So you should be able to, as a graduating senior or senior, you should be able to sit down in a Word document and type up 10 pages talking about CAPM and beta off the top of your head. If you can't do that, go back and restudy it. It's the most important theory in finance. It's the most referenced paper. He won a Nobel Prize for coming up with this theory. But why is it that y'all see it in 4 or 5 classes and almost no students can explain CAPM? Is it the student's fault or the professor's fault? If 99% of students start getting it, whom do you blame? I blame the professors. It's got to be the system's fault. So probably you did most of your CAPM multiple choice questions, and that's not a way to learn CAPM. So you got to learn this. You need to sit down and talk about CAPM in a very intelligent way and explain it, explain the flaws in beta. And you can look at the flaws in beta. It's pretty simple to do. You just Google CAPM is beta dead. You'll get all kinds of really, really interesting articles on beta. Is CAPM beta dead or alive? Depends on how you measure it. I believe it's alive, but I believe it's alive because I'm using a forecast beta and not a regression beta. If you use a regression beta, I think beta is dead. I think it's not valuable to you. It's going to make a lot of mistakes. But if you're using a forecast beta, definitely I think it's still there. Here's a CFA level exam. Explain my CFA level 1 It was half written and half multiple choice. The written was in the morning. I felt pretty comfortable coming out of the morning session. The afternoon multiple choice, I left that knowing I passed this exam, I have no doubt, because probably 10% of the questions were CAPM questions. They just kept asking them over and over again. And I remember I went to a review class. This was right before the exam. And at the end of the class, the two guys in front of me go, "What's this beta thing he was talking about?" And I'm going, "I think I'm in good shape." I mean, they missed that whole lecture. But solving beta using CAPM, there's things you're going to see that I don't think anybody does in practice. I don't know how many people actually use CAPM in practice. That's kind of an interesting question. You're going to see that the investment banking, they do tend to use betas, but most of them use regression betas. I had one firm come in and present to us, and they said, we just use a 10% discount rate for everybody. And I thought, that's just crazy. I didn't push them on it. My professor's side was like, are you insane? That's crazy. Who would do that? So you're going to use a 10% discount rate for Walmart and for NVIDIA? That makes no sense to me at all. But that's what they said. They just gave up on beta entirely. Dead and kicking. I love that. That's a great quote. Is not dead. It works better for average, whatever. So it's controversial. I like it. Dr. Damodaran uses it. So that's pretty good company there. He's an approach. It's amazing to me. I've been using my approach after seeing that portfolio manager. I've been using my approach for years, and then I watched Damodaran's class, and either he was stealing from me or we just came up to it randomly, kind of each of us on our own. But his approach is exactly the same as mine. So I feel even more comfortable about it. So make it a forecast. So when you're valuing the stock, William Sharp says systematic risk is all you care about because you can eliminate the unsystematic. So how do you forecast? Let me get to the forecast. Yeah, I'm going to do it separately so y'all can take some notes. Y'all should be writing this down. Who wants to write a 10-page paper on CAPM? Anybody can do it? Anybody feel like you could do it in here? How much of your finance could you write off the top of your head without any notes? Cost benefit analysis, CAPM, option pricing theory. So yeah, there's something going on. How about financial analysis? How would you do that? What template could you do for financial analysis? Maybe you might start with what? Liquidity under short-term viability. Okay, so you have a template. You're going to forget that next week after you finish the paper, or 2 weeks from now. So retention is key. You got to retain this stuff because when you start your job, we actually use this. I'm worried too many finance majors think nothing we teach in academia is used in practice. I'll just get the exams, get the papers, graduate, and then I'll learn what I'm supposed to learn. No, they actually use this stuff in practice. So don't just learn it and forget it. Actually know it. Make it permanent. So CAPM is one of those things you just got to know. It's so critical. Okay, let's talk about forecasting beta. Well, since I'm asking you what you remember, anybody remember this from my investment class? This is when y'all depressed me. I see people from that class, they're avoiding eye contact. But random hire them. Huh?
Generally, it was like 0.5, 1, or 1.
Well, okay, so the range I generally use, I might get down to as low as 0.4. I might get as high as 3.5. I would be really cautious on the low ones because again, you're going to get such a low discount rate. It's going to be hard to do your valuations. 3.5 can make sense for a firm that's just overladen with debt, but that's not what I'm forecasting. So what's the first thing I would do? Well, that's one of them. We'll talk about that. What do you do before that? That's good. You remove.
Cyclical, non-cyclical?
Okay. Define the firm. Cyclical, defensive. Very good. All right. So Homer is going to make me happy tonight. Someone else can jump in. What's the third one? Financial leverage. All right. Good. And then what's the last one that what UT Austin people do to start with?
Family finance.
Yeah, so regression beta, but we're actually going to do a rolling historical beta as input, not as answer. All right. You will lose a lot of points. Get this in your notes. You'll lose a lot of points if you do all of this and then ignore it and just use that. All right. I'm going to show you how you can avoid that problem. A lot of students do that. They do all this discussion up here. This implies 1.2. This implies maybe 1.3. This takes me back to 1.15. History suggests 0.7, so I'm going to use 0.7. I get papers like that. It's like, why did you do all of this? Which is the one you're most likely to ignore? The historical one, right? There can be noise, all kinds of things in there. So that's what you're going to do. So define your firm. So what are you looking for? You got to talk about systematic risks. The most important one is the economy. So the way I think about cyclical defensive, if we had a recession, would firm perform above average, defensive, or below average? That's what you're asking. And here your main focus, and I should have said this first, but your main focus is revenues. Because operating leverage and financial leverage are going to be how we get the net income. So think about the revenues of this firm. We go into a recession, what happens to Ford Motor Company? Going to go down. Fewer people are going to buy cars and worry about losing their job. What's going to happen to Walmart? They could go down, but they may stay the same or may be okay. So we're not saying that defensive companies, they do great in recessions. Walmart had some struggles in 2008. They did better than everybody else. The question is, do the revenues rise or fall in recession is versus the average firm? We had a really, really serious recession, you know, like China attacking Taiwan. Yeah, you could see a lot of firms lose revenue. People just bunker down in their houses. They buy nothing but, what is it? Ramen noodles? Ramen noodles? What is that? I've never eaten those in my life. I have to try them. Is that what college students eat all the time? I just don't know what they are. But almost everybody's going to see revenues drop. But the question is relative to the average. Beta is always about how you perform versus the average. So you don't have to argue that your firm would do great in a recession. You just have to say it would do better than average. So what kind of business is this? You're also looking at the sector and the industry. There are certain sectors that are high beta by definition. Consumer discretionary, some of you are consumer discretionary, that's going to be high beta. Consumer staples, by definition, that's going to be low beta. Utilities, none of you are doing utilities, that's low beta. Tech is generally higher beta, but not always, kind of depends on the firm. Some people are arguing that Apple's becoming more of a staple just because people would lose their house before they give up their iPhone. But you know, you can debate those. That's where the history is going to help you looking at that. But there's definitely sector influences and industry influences. One thing that's really interesting that you could do, run a rolling beta, not on the stock, but on industry. How would you do that? How can you figure out beta of an industry?
Could the chemical industry or companies in the chemical industry have a lower negative beta based off like a specific?
Gold is the only one. Most chemicals are production chemicals. So the cleaning company, I forgot the name of it, but the clean, maybe it is, but you're selling, if it's, a lot of them are business to business. And when you're business to business, usually you're considered higher beta. Most material firms are higher beta. Definitely steel, right? Definitely. Gold tends to be a, you know, where you go in a crisis. So gold may be lower. Some people argue gold is a negative beta. I'm not sure that's true. But yeah, but here's what you could do, Reed. So you could actually find an ETF for chemical companies and run the rolling beta of that ETF. Or of that, you can find a Bloomberg will have an index. So you can actually, what if you're worried that your firm is a lot different than its competitors? You want to see something unusual is going on. Or Sebastian and those of you that don't have, or and Diego, you may have to do that because you may not have enough history for DoorDash. So go find DoorDash's competitors and run a rolling beta on them, and then you can get a sense of the industry. All right, so you can get pretty good numbers by using industry data and getting the beta off of that to give you a sense of where your firm fits in. Or you can do several companies and graph them all together to kind of see if there's a trend. It is interesting if your firm, you graph all your competitors and your firm's doing something wild, make you stop and ask, does it have to do something with financial leverage, operating leverage? Kroger, someone's doing Kroger in here, right? Yeah, so Kroger's interesting. Kroger, you think is a really, really low beta stock, but it has had, maybe not now, but it has had really, really high debt. So you might discover their beta looks higher than you would expect it because of all that high debt. So you can compare Kroger's to other, if you can find other grocery stores. That's getting really hard to do with Walmart out there. But if you can find other grocery stores, you might find Kroger looks higher because they have higher debts. So sometimes the beta will look different just because of these two things. All right. We'll go through some examples of this section. It's a subjective thing. You're looking at your firm and you're thinking about how this firm would do in a recession versus the typical firm. Don't ask how would it do in a recession. Ask how it would do in a recession versus a typical firm. Better than average or worse than average. Operating leverage, you may remember what that is. Yeah, the level of fixed cost. So there's a couple things with fixed costs. So good example is Netflix. We might have talked about this earlier, but I'll do it again. Versus Spotify. Did we talk about this earlier? Remember? Well, I've got 3 classes that are using CAP, and we're back to it. CAPM is everywhere. I'm like, what did I say in that class? And plus, I'm 62 years old. I can't remember. I'll be lucky to make it home tonight. So yeah, it's hard to remember all these kind of stuff. So Netflix started doing its own production. That's heavy fixed costs. Because they're spending themselves a lot of investment, production costs, but they get to keep all of that. They sell more subscriptions. They get to keep all of that. That's a fixed cost. Spotify does a lot of licensing. So when their customers buy more, they got to pay their licensors a lot more money. So they're mainly variable costs. What does that do? Well, for Netflix, if you're a growing company, you love fixed costs because your net income is going to zoom up. But in a crisis, they're going to be in bad shape. Spotify growth, you almost wish you had more fixed costs because as you grow, your costs just keep growing with you and your income doesn't grow as much. So operating leverage is good and bad. It's great for growing companies, but so the good side is that it helps growth. So for DoorDash, especially. So Sebastian has a firm that's losing money, but it's got a lot of fixed costs. I think maybe he may find I don't have fixed costs, but DoorDash is hoping they have fixed costs because as their revenue keeps shooting up and their revenues are growing fast, their net income is going to grow much, much, much faster. You saw that with Uber. You see it with other firms that have they've come, even Amazon. Amazon was losing money there, but a lot of fixed costs. And when they came out, when their revenue started growing, you saw their net income just shoot up really, really, really fast. NVIDIA has a lot of fixed costs. Their biggest costs are their employees. They don't have production, but they do have a lot of fixed costs for their employees. And so revenue growth causes their net income to really, really shoot up. But on the bad side, the downside, it's more risky. So what does it do to beta? Beta will be higher. So firms with high fixed costs, it's great. You're going to see them be more profitable as they grow, especially young firms. You prefer young firms. Generally prefer young firms with more fixed costs than variable costs because they're going to get out of the slump a lot faster. But you will, even though you like that, you're still going to use a higher beta for those firms because their net income is much more volatile than a firm with a lot of variable costs. How do we measure? Does anyone remember how I measured it in our class?
The margins.
Margins, what I do with margins.
Okay.
Yeah, standard deviation of margins. That's a It's a sweet thing, all right? I have not seen anyone else that does it like this. So I think it's a sweet thing, but I can't confirm it using sweet the way y'all use sweet, but I can't confirm it with any of the professors. Someone said they thought they saw someone doing something very similar to that. We'll come back and we'll look at some data. I provide you a database that allows you to, you don't have to calculate it yourself, that you can compare the standard deviation of the margins of your company to the standard deviations of the margin of a typical company. And my argument is higher standard deviation indicates higher fixed cost. That's my argument. I can't prove it because I know there's other things going on in here that's driving that. But it's very logical because that's the whole theory behind fixed cost. Fixed cost is going to make your net income more volatile because in good years, you're going to really lose a lot. I mean, good years, you're going to make a lot. Bad years, you're going to lose a lot. It's going to make you more volatile. We'll talk about this more. I do break it up between net margin and gross margin. So gross margin, I'm looking at two things. I'm looking at the elasticity of the firm's demand. If they have a very elastic demand product, small changes in price are going to kill their margins because they're going to lose customers. So if someone's doing Netflix, right, Hiram?
Yeah.
So price elasticity. What has Netflix and Disney been doing last few years? Raising their fees. What has that done to their subscription? Have they lost customers? What was Netflix charging now? $20 a month, maybe?
I think for their base one, it's like 20.
20. So if they go from 20 to 25, what is that going to do? Are they going to lose? So the key here is you raise prices 3% and volumes fall 5%. That's price elasticity. That's a very sensitive product. I'm trying to think of some of your companies on price elasticity. That's elastic. You raise prices 3% and volumes fall 1%. That's inelastic. And how far would you go? Well, that helps you, right? That's great. Raise your prices 10%, your volumes fall 2%. That's what you want to do. You make a lot of money doing that. That's kind of the cigarette company, right? You got an addicted person, now probably food. We're all addicted to all this stuff, all this sugar and fructose. Yeah, that makes us, we can't help but keep buying these products. That's what you want as a company. That's why cigarette companies are so cash rich. Cigarette companies, their raised prices is taxes, but even with the higher taxes, they don't lose many customers, at least not canceling their product. They may, from health reasons, lose customers. All right, that's the gross margin side. And then the net margin side, it's the gross margin spill through plus fixed cost. So there's two things going on here. There's the type of product it is. Is it elastic or inelastic? And then the fixed cost. So there are more than one things going on here. So I do the standard deviation of gross margin. So you can look and see if that most firms' gross margins are pretty stable. They don't move around all over the place. So,
Margins are over like operating income.
I usually do EBITDA. But you can use EBIT. Well, I think actually I use EBIT. Because remember, for the ROE decomposition, you got to use EBIT so that the formula works out.
For gross margins, it's also.
No, gross margin is revenue minus cost of goods sold over revenues. That's your gross. That's the definition of a gross margin. Some of your firms may not have gross margins. And sometimes it gets really confusing. So airlines, if you go to Bloomberg says airlines don't have gross margins. If you go to Yahoo Finance, they do have margins. So it's really frustrating. There are some of your firms may not have gross margins, so you'll just have to ignore that part of the analysis. Like banks don't have gross margins. So the question there is, will a change in price materially impact their number of customers? Now think about McDonald's. McDonald's prices have come up pretty strongly, haven't they? They're definitely losing customers. I don't know what a Happy Meal is now. They used to have a dollar menu. Can y'all believe that? What a dollar menu now is, what is it, one fry or something? They couldn't even, there's no way they could make any money off of that. There was a while there where they were just making the hamburger smaller, not McDonald's, with other firms just making them smaller. There was actually, where I worked, when I was like, I taught trumpet lessons when I was in college, and the studio I worked at, it had a hamburger store. I kid you not, the name of the hamburger store was 39-cent hamburgers. I thought that's a really stupid name for a company, because what are you going to do with inflation over time? You know, you're going to have to keep making, and their hamburgers are already pretty small. So, but I'm sure McDonald's has lost customers. It's gotten really expensive to eat there, and it's not very good food to begin with, at least from a health standpoint. People are going to start eating more at home, so that's key. What about HEB raising prices? Well, that's the cheapest you can go, right? Buying your own food. Where are you going to go to save money from HEB? HEB and Walmart, you can compare them, but can you go any cheaper than that? You can grow your own food. How many people are going to do that? So, HEB is going to be a lot less elastic than a McDonald's, just because people can make those choices to eat at home. I think there's a time where it's actually could be cheaper to eat at McDonald's than it was to buy food at HEB. From a calorie, if you're looking at cost per calorie, you could get more calories from McDonald's than you could in some grocery stores. All right, so that's what you're looking for. You want to somewhat talk about your firm from this standpoint, because that's gonna leverage up whatever's happening up here. So if your firm is cyclical, it loses customers in a recession, and it has high fixed costs, that's just going to exacerbate that beta. It's going to go up much higher. So I think it's a good thing that Netflix has fixed costs. I think it's wonderful, because I think they're doing great. They're growing, but it does make them riskier. So it's a good and bad. Operating leverage is not all bad. It's good side and bad side. Why did I type 1.3 there? I don't remember. So there's probably some reason for it. All right, I'll show you that spreadsheet. We'll do it next class. What is financial leverage? It's just the best measure there is probably debt to, I forget exactly which one I use, but we'll look and see. Or it might be debt to equity. I can't remember which one. I think I might have done debt to equity. The problem with debt to equity is there's so many firms with negative net worth. So firms, some of you that have negative net worth, you're going to have a tough time making this adjustment. So you have to find something else, debt to EBITDA, something else that you can figure out how much debt they have, debt to assets. So there's other ratios that we can pull out of Capital IQ to compare, that we could do that. If you need that, let me know, and I can build that for you and substitute it. That's the easiest part for me to pull in, because I only bring in 1 year. On the net margins and the gross margins, I'll bring in like 15, 20 years. But on debt to equity or debt to EBITDA, I only bring in that one thing. So to update the spreadsheet, I only have to bring in one thing from Bloomberg, and then you can see your firm. So let me know if you're getting an NA on that part of the spreadsheet, and I'll fix it. Now, one thing you might want to do on both of these. So when we talk about leverage, I would encourage you to graph several companies, or table several companies, not graph, sorry. Look at several companies that are related. So if you're doing Kroger's, look at their debt to equity, and then look at Walmart, look at Costco. Is your firm radically different than everybody else, or is it real similar? And read, this is important for material companies. They're probably all over the board. So you want to look and see, because the question you're trying to ask is this company related or industry related? If your firm is really different than everybody else, is this an industry thing or is it a company thing? And it's easy to do in the spreadsheet, because all you have to do is go find 5 or 6 companies, write them down, and you've got it. You can make a really nice table. You could do a bar chart that compares them. And that would really help you with your beta, because it may, you doing that, you might say, my firm has got to have a higher beta than its industry. So if you did the rolling beta on the ETF, and then you looked at your company versus others, it's going to really give you great insight for really, not for a college class, but I mean in practice. If you did this in a job, it would be very impressive. So I encourage you, think in those terms. If you did this and showed this into an interview, that you did this, they'd be really impressed. It'd be a really good thing to do because you're getting into the true risk of this company and trying to understand it at all levels. Most people, like you look at the motor end, all they adjust for is financial leverage. They'll talk to operating leverage, but they don't have any way, they don't show a way to measure it. I'm trying to give you a way to measure it. It doesn't give you a formula, say if it's 1.3, do this or whatever, but it does give you a relative so you can see how much you may want to push that beta up or down. All right. So here, more financial leverage equals higher beta. And this one actually has a formula. I gave you the formula right there. I'm not recommending you do this formula because it's just going to be too much, but you could if you wanted to. You're looking at levered betas. So you can take the levered betas, take your firm's levered beta and adjust out the debt to equity to get an unlevered beta. And you can do that comparing to the industry, get an industry unlevered beta. You can go either direction, try to look at that. What this does show you though is how much of an impact leverage has on the beta. You can see it formulaically. You could do some tests on that. That's a formula that's really famous in academia, but not used all that much in practitioners. So you may not see it all that much on a practitioner side. And then history. All right, let me show you what I have on history. I think I put this in y'all's as well, but I have this YouTube. So I used to do this. Actually, Packard is the one I was talking about. I used to do this with Yahoo Finance. Yahoo Finance wants to make money for a change. So you can't get the data out of here. So you have to use Bloomberg. But I'll give you the Bloomberg file. So all you have to do is plug your company's ticker in there. And it will automatically update everything in Bloomberg. And then you do the rolling beta. It shows you how to do that. And then you do the graph. Y'all remember seeing this, right? That if you had me before, you can watch the video. It shows you how to do the whole thing. So this is the rolling beta. I don't like a lot of white space. And get past that point. So I like to get rid of the white space and look at it. So if you look at Packer, none of you are doing Packer, I don't think. But if you're UT Austin, which beta are you using? Using that beta right there. Does that look like the right beta for Packer? No. You can get a really high valuation. That's actually like, it's below 1. Packer makes massive diesel engines for diesel trucks. Does that sound like a below 1 beta company? Absolutely not. This is a high beta company, but for some reason, they were really low here recently. There's the median, that makes more sense, and there's the top up there. This is the chart you're going to use, but just as an input. The proof. Now remember the ones with the dot and the slope, like you do in some of the other classes. You can't get that information from here. So this is the type of chart that portfolio manager showed for Merck. And say, what is Packer doing? Are they selling like 3 diesel? You have to buy 3 diesel engines at once, or you can't buy. And then they started selling groceries, and then they went back to diesel engines. You know, it doesn't make any sense. The business has not changed. It's the same business. So what's going on? This could have been, I can't see the years here, but let's say this is 2008. What's going on in 2008? Well, if you're not a bank, your beta came down. If you're a bank, your beta went up because the market's beta has to be 1. So if one industry is seeing their betas shoot up, that means everybody else's betas are coming down. That could have been 2008. Could have been the dot-com crisis. They're not a tech stock, so their betas came down. What else can you do with this? You can run this with your ETF. You can run it with other companies in the industry. A really good chart that's really, really good to look would be to have 3 or 4 competitors on the same chart and just compare them across time. That would be really helpful. Once you get one set up, now all I'm doing is this part. You've got to do everything all the file does is bring in the prices. You got to do everything else. But once you do that, once you build the first one, all you got to do is capture that graph or capture that data and then change the ticker for somebody else, and you automatically have a graph for the next one. So you can easily create the graphs that you need to compare companies. You could also put an ETF ticker in here as well. So if you want to do an ETF that's of your industry or of your sector, you could put that in there. You would have that rolling graph as well. You may have a little bit of trouble of the starting date. So you might have to play around a little bit with that to see. So you might find an ETF only go back to 1995, not back. So you'll have to make a little adjustment. So it might get a little frustrating, but you can do some really cool stuff with this chart. This is something I'd recommend you take with you. After you build it, this one's not going to help you, but after you build it, take it with you because it's a really good thing to do. I had one student, oh my word. He saw me do this in class, so he created a website that does this. But he did the website that you could do 4 or 5 companies at once if you wanted to. You know, that's really, really cool. But his website doesn't work anymore because he wrote it like in SQL and now he wants to do it in Python, and it's like, and you know how much I was paying him to do this for me, right? You know, zeros. So I don't have a lot of space. So if one of y'all want to write a Python program to create a website that does this, that you can do multiple companies, go for it. How would I write it? I would go to Copilot and say, write me a Python program that, and then that's how I would do it. But you'd have to bring in the data. But the problem with doing this is getting the data, and Yahoo Finance is making this really, really tough to do. So you're not able to get the data, and you can't really tie this. Bloomberg does have a Python function, but if you don't have Bloomberg, it's not going to work. So it's a little tough. So we'll do that. So what we're going to do next class is we're going to walk through this whole thing for a couple of companies, and we'll talk through how to do it. If you want me to do your company or something similar, we can certainly do that. All right, I'll stop it there.